folks. Welcome back to the Real Men of Real Estate. I've been having a fascinating chat here with Patrick Kappell on how we got where we are after the pandemic in this higher interest rate real estate market. Wow, it seems like sort of obvious when you talk about it, but I have to admit that coming up, I didn't know. Uh, what's next? What do you feel like is going to be the next couple steps?
Yeah, so what's next? And just to snippet recap, what happened is pandemic, government flooded us with a bunch of money. That
Uh-huh.
means inflation goes up. Interest rates were down during the pandemic. All of a sudden, home prices went up. Interest rates have now gone back up, and we're still seeing home prices elevated. So, what direction are we going to go? And one of those reasons is just not enough inventory. In San
Hmm.
Diego, we hit a new record median sales price of $1 million per home in
That's
June,
incredible.
and that's with 7% interest rates. So, what is the future to hold? If we're selling homes at new record high sales prices because of a lack of supply and a heightened demand at 7% interest rates,
Right.
what's going to happen to home prices when rates go down? What's going to happen to home prices when rates go down and demand goes up even further? And oh, by the way, on the heels of millennial is Gen Z, and statistically, more Gen Zers want to buy homes than even millennials.
Oh,
So,
really? That I didn't see
what
that. That's fascinating.
what does the next 12 months have in store, and more importantly, the next 5 to 10 years? Well, as we're peaking out on interest rates, we all know
Hmm.
that the Fed's
Right.
disclosed it. As we get into the next 6 to 12 months, you'll see interest rates peak and then start to slowly, not quickly, but slowly come back down.
Hmm.
Right now, we're a little over 7. When we get into the sixes, you will not see a big change. As interest rates get into the fives, you'll see home prices keep going up, though.
Uh-huh.
As interest rates get into the fives, you'll start seeing some buyers that have been waiting on the bench come off the bench. You'll start seeing some sellers that have been holding on selling, listing their properties, but again, they want to then go buy a property.
Yeah.
Once you see us get back into the fours, the market will be bananas. The entire time, as we go from the sevens to the sixes to the fives to the fours, you will see real estate values continue to go up simply because of lack of supply relative to demand. When we get in the fives, you'll see real estate values really start to skyrocket.
Okay.
Now, someone's going to listen to this and say they're listening to this in maybe September, October, and they're seeing prices go down. Why is that? Seasonality. Guys, every year since the beginning of mankind, from August to January, real estate prices go down a little bit. That is seasonality, not
Hmm.
economics. And
Got
in
it.
February, we start seeing prices go back up. But you'll see year over year prices continue to go up for the foreseeable future, next 5 to 10 years. As I'm telling my clients right now, don't wait to buy, buy and then wait. Now is the time to buy. And I am a buyer, I'm a client, I'm a consumer. I plan on buying something before the end of this year. I recommend buying now while interest rates are high and prices are
Are
low.
low.
And you
Right.
might be thinking prices are high. Price of everything is high compared to what it used to be. A hamburger at McDonald's is high compared
Yeah.
to what it used to be. You got to be able to see the future, and prices today are low compared to
Right.
what they will be in 2 years, in 3 years, in 5 years.
Hmm.
So buy now when interest rates are high, ensuring prices are still pretty low. And as interest rates go down, you'll thus see home prices go up, but you'll be happy because you already bought your house, and you will then refinance your mortgage into a lower interest rate. Because you can buy a home today with a 7% interest rate, and a year or two from now, you can refinance it into a
Hmm.
6%, a 5%. You can refinance as many times as you want.
Yeah. I remember doing that after the crash. I bought in 2008 when it was still 7% interest rate. I refinanced a couple times on the way down. Yeah, it works. That's for sure. So what's going to be driving that interest rate drop, do you suppose?
What's going to be driving it is realizing that we've solved it. It
Hmm.
peaked out. We're on the downward trend. The
Right.
Federal Reserve doesn't need to raise rates anymore. But to be clear, the 30-year mortgage is not directly tied to the federal funds rate, the rate that the Fed keeps on raising.
Hmm.
The 30-year mortgage is more so tied to the 10-year Treasury.
Right.
The
T-notes.
10-year
Yep.
Treasury has been going up over the last years. The Fed has been raising rates. And here's another interesting fact a lot of folks really just don't know is the spread between the 30-year mortgage and the 10-year treasury for the last 50 years is usually about 1.5%.
That's it.
1.5%.
All right.
The 10-year treasury for the last year has really been dancing around 4% plus or minus. So what's 1.5% plus 4%? 5.5%. So mortgages should be at 5.5% today. And this entire year they should have been, but they haven't been. And why is that? It's because mortgage lenders, mortgage banknote holders on Wall Street don't really want to give out mortgages, what is usually a 10 to 30-year product, knowing that their investment in that mortgage is going to get refinanced in a year or two. And it's not as long as of a
right. They're not going to hold it long enough to make their money. Got it.
So they got to increase the spreads this year because they know whoever buys a house this year or last year is going to refi when rates go down. In that 30-year mortgage investment, mortgages usually get refied about every 10 years, but that longer term investment is not really a long-term investment. So they want to get a higher return, Wall Street does, on that mortgage. Thus, you're seeing 7% rates, which are about 3% higher than the 10-year treasury. And we're historically usually about 1.5. So even if the Fed doesn't do anything more over the next 6 to 12 months, you'll see the 30-year mortgage start to come in closer to the close the gap between it and the 10-year treasury.
Got it. Okay, fascinating. What sort of time frame is that on, do you suppose?
6 to 12 months. The Fed has really slowed down. They skipped the rate hike. Then they just did a rate hike. They signaled they might do one more. Once the Fed says we're done hiking rates, and they have not said that yet. They paused, but they have not said they're done. Once the Fed says we're done hiking rates, and number two, once Wall Street believes they're done hiking rates, and that'll probably be a couple of months after the Fed says it, then Wall Street will start to believe, okay, things are getting back to normal. We're taming things. Rates might start going down. The Fed funds rate, 10-year treasury might start going down. And then you'll start seeing the gap between the 10-year treasury and the 30-year mortgage start to close in on that 1.5% spread it usually has. When is that going to happen? Probably, this is one of those things you can't say with certainty because I'm not the Fed, but probably by December. Probably by December, the Fed's going to say it's the end of this year, 4 months out. The Fed will say, all right, we're done. Let's just let things go. And we'll start to see the 30-year start to drop. When is it really going to start to close in? Probably 2024, during the 2024 year.
It sounds like this time next year we might be staring 5%.
I don't know about 5% this time next year, but maybe high fives, low sixes.
Yeah.
And by the end of 2024, maybe the low fives.
Got it.
But again, as you see those rates go to low sixes, a high fives, you're going to see home values really start to skyrocket.
Yeah, right. Buying power will go back up, and we'll start that
process. Why we're telling our clients,
again.
Buy now, refi later.
Got it. All right. Well, that's a sound strategy, especially in Southern California, as you know.
Especially in Southern California.
Yeah.
Really throughout the nation. In Southern California, we see more dramatic price rises because of the constraints to supply that we have, and also because of all the people moving here. And here's another misconception most Americans have, and that is that everyone's leaving California.
I love that misconception. Even UCSD did a study on that disproved it.
Yeah. Based on the latest census, California's population has grown. Northern California, yes, has lost people. Southern California has gained a tremendous amount of people. And I always say when it comes to real estate values, it does not matter as much how many people move in and out. It matters who moves in and out. And I just read a thing yesterday about California in the last 2 years gained over 100,000 millionaire income earners in just the last 2 years.
Really?
And no state has gained that many millionaire income earners in any 10-year period. We just did it in 2 years. Almost 1%, almost 1%, 0.8% to be exact, of all Californians make $1 million or more per year. The state in second place, New York. And they're at half of that. 0.4% of New Yorkers make $1 million more. So California, yes, some people are moving out of California. More people from California move to Texas than any other state, but more Texans move to California than any other state.
Oh
The
man,
difference is we're sending away the people moving out of California are not a blanket statement here, but just the majority, more than 50%, are those with lower income levels,
sure.
lower education levels, and they just can't afford it. The
Which
folks
makes
moving into
sense. It is tough to
California,
afford things here. Yeah.
yeah, it's not cheap, but you know
No.
what? Neither are diamonds, and everyone loves a diamond. And California is not cheap because it's amazing. I mean, sunshine 12 months a year. And the folks moving here are the higher educated, higher income, higher net worth folks. And that
Mhm.
trend is just going to continue. The cool thing is, though, if you buy real estate in California, you can be a guy that lives in a garage and 15 years later have over 10 million in real estate. You just got to have one plan, and that is buy real estate,
Mhm.
never sell
And
it.
stick to it.
Everything else is noise. Buy real
Yeah.
estate, never sell it.
All right. That's some pretty sound advice. Well, we're
Mhm.
gonna have to take another commercial break here in a second. So a lot of impressive statistics there. I didn't know some of that's in any part. So
I
thanks.
love
That's very
math and
cool.
stats and data. And if you make database
It,
decisions, you won't
mhm.
always be right, but you'll be right more than you're wrong.
More than yeah,
And
yeah.
that's all
Emotions
about
get
winning.
you.
Yeah.
Right on. Well, folks out there listening, you can find us on 1050 AM or 106.5 FM. I'm your host, Dan Redig, here with Patrick Kappell talking about this real estate cycle we're in. Thanks for listening. We'll see you after these messages.